It's our weekend update video for Accounting 203. Hello, everybody. Professor Hasse here. Today's date is Saturday, July 8th, and you'll be wrapping up your assignment number 3 this weekend on chapters 3 and 4, adjusting journal entries and closing entries, which you have a spreadsheet to do all your work on. Today, our topic is on our week 5 topic, retail and inventory accounting. Just another step in the accounting process to learn about how other types of businesses do accounting. Our main first 4 weeks was on a service industry, providing services, legal, consulting, whatever. Now we're going to talk about retail accounting and how that main difference is the subject of inventory. You buy product for resale, and that's the key part about this. A couple problems, 5.1 and 6.1 in our chapters are good templates and reviews of that material. So let's take a look at those now. Now here's a couple of spreadsheets, or a spreadsheet that I have posted as one of our class review spreadsheet files. It covers chapters 5 and 6, merchandise accounting and inventory accounting. And these are 2 examples of which can be your study guide for these chapters, problem 5.1a and problem 6.1a from that material. Basically, it's the same transactions. You're just recording for inventory. Remember, retail accounting is the purchase of product that you're going to sell again to another a customer. You're not producing a product, you're just buying a product and then reselling it. When it becomes an expense, that's when you sell the product. So let me give you an example. Here's a transaction on July 1st. The company orders $6,000 of product and they pay for it on credit. So they're purchasing the inventory. It goes into a debit account, merchandise inventory. That is an asset account, inventory. And then they purchase it on credit for $6,000. So accounts payable. We've seen that transaction before. Then the very next day on July 2nd, they take some of that inventory and sell it to their customers. They sell it to them on credit at a retail price of $900. So they give them an invoice, debit accounts receivable. They owe the money to us, and it's a credit to sales. We've sold $900 at retail of that merchandise. But if you notice, right underneath that transaction is a transaction debiting cost of goods sold and inventory $500. What this is the cost of that inventory that you sold for $900. In other words, we bought $6,000, but now we're selling off $500 of that inventory. What's our inventory balance now? $5,500, but we're selling it for a retail price of $900. So in other words, that's the markup. It cost us $500. We're selling it to our customers for $900, a markup or a gross profit of $400. Pretty simple. The key thing, this is the difference between the accounting that we did for a service agency or a service company earlier in our course, is that you have to record the retail price of the product as sales, and then the cost of the product to you as now becomes an expense, the $500. That's the only major difference between this accounting and the accounting of the prior work in our class. You have to record the retail price and the cost of the merchandise as an expense. It's an inventory, it's an asset. Then when you sell it, it goes from being an asset to an expense. And the cost of goods sold is an expense account. And you lower your inventory balance because you sold that product. What did you sell it for? $900. And in this case, you billed your customer receivable, but you still record the revenue as sales. Well, let's look at a couple more examples of this type of retail inventory. Many times you purchase inventory and you have to pay the freight. When they deliver it to your store or deliver it to your business, there's also a freight charge of bringing that inventory to your store. You have to pay the trucking company that delivers the merchandise. And in this case, the freight charge was $125, of which we paid in cash. And then the debit goes into inventory to add to the cost of the product that you're selling, the freight cost of delivering the product to you. So you debit inventory $125. That's the freight charge. The next transaction, now we sell more product. And this time, instead of billing, we get cash. We sell $1,700 of retail product at debit, cash, and credit sales. Now, in the problem, they tell us that this retail price of $1,700 cost us $1,300 to purchase from that vendor back here of $6,000. So notice, just like we did up here, we have to record the cost of goods sold or the expense or the cost of that merchandise as a debit for $1,300, and we credit inventory $1,300. So now our inventory balance is 6,000 less the 5,000 here, which is 5,500. We added in another inventory amount as freight, so that's 5,625 balance. And now we reduce that by another $1,300 because we're selling more product. So that brings us down to about $4,300. Again, retail price books into sales. The cost books as an expense and reduce the inventory balance by a credit. Then on July 9th, looks like we purchased some more inventory, $2,200, and we buy it on credit, accounts payable. More inventory now comes in ready to sell. But this example has a little bit of a problem. When we purchased the $2,200 of inventory and they delivered it to us on July 11th, we found that $200 of that inventory we didn't like. Either it was damaged or it wasn't the product that we ordered from the vendor. So we make what is called a purchase return entry, where we lower accounts payable by the returned merchandise, $200 debit, and we lower or credit inventory because we're returning part of that $2,200 as returning it back to the vendor because we didn't like it. We're returning it. $200 credit to inventory. Okay? So we're returning merchandise, and I'm sure some of you have done that in your own everyday lives. When you return merchandise, and either you get a credit back on your credit card or you get your money back. The next transaction is an interesting transaction because in this transaction, it says that we're selling our product. We're collecting. Remember up here, we had this accounts receivable for $900. Well, part of the sale was you can get a discount of 2% if you pay within 10 days of the invoice. In other words, when I sold this $900 to this customer, I told the customer to encourage them to pay me on time. I will give you a 2% discount on your receivable balance if you pay within 10 days of the purchase or the invoice. Well, lo and behold, 10 days later on July 12th, they pay me the $900, but I give them a 2% discount. 2% of 900 is 18 bucks. So I wipe out the receivable, but I only collect cash, the $900 less the discount. So they're only going to give me cash of $882. The remaining $18 goes into a debit account on sales discounts, which reduces the sale of that by $18. In other words, I'm willing to give them a discount so I get the money quicker. So I sold it to them for $900, but now there's going to be a debit in the revenue account sales discount, lowering how much I sold them by 18 bucks because I gave them a 2% discount. And as a lot of you know, in retail, many companies give their customers discounts, encouraging them either to buy the product or encouraging them to pay quicker. And that's what's going on here. The next transaction is, remember when we purchased the inventory up here for $6,000. That vendor also gave us a discount. When we purchased it from the vendor said, if you pay this invoice or this bill within 15 days, we will give you a 10% discount. Or excuse me, a 1% discount. All right, cool. So I owe $6,000. I'm paying within 15 days, so I get a 1% discount of $6,000. I get a discount of $60. So I now credit cash. So now I write them a check for the $60 minus how much I owe them, $5,940. And the discount on the purchase goes as a credit to inventory. What I'm doing is I'm lowering my inventory balance because I'm only really purchasing $5,940 of inventory because I'm getting a discount when I pay the bill. Debit payable, wiping out the payable, credit the discount, 1%, and writing a check to that vendor for the difference, $5,940. All typical examples of the retail business. Then the next one is we sell more product for $1,200, and this is billed sales receivable, of which that $1,200 was the retail price. Remember, every sale, 2 entries, one for the revenue and one for the expense. It cost us $800 to purchase the product that we sold for $1,200. Debit cost of goods sold, credit inventory. Now, at the same time, some customers who bought some goods from us returned the merchandise to us. In other words, we sold some product and they didn't like the product, and they're returning that product to us. It cost $100. So we're going to lower their amount that they owe us, credit receivable, by the amount of product that they returned to us, $80. And at the same time, we return that as a debit to sales returns. In other words, another debit balance revenue account that shows our sales are going to be reduced because some of the product was returned to us. All right. Sales returns, sales discounts, purchase returns, purchase discounts, all examples of the process of retail accounting. On this purchase of, remember we bought $2,200 of inventory here, and then we returned $200. So we had a balance of $2,000. Well, part of that deal was if you pay us within 15 days, we'll give you a 2% discount. Well, we have a balance of $2,000, so we're going to take a 2% discount. 2% of 2,000 is $40. Thus, we only have to pay the vendor $1,960 because we're paying within the discount period. Because this is a purchase, we lower our inventory balance by that discount, and we wipe out the payable up here. Now we have another example. Remember, we had that sale of accounts receivable here of $1,200, of which we gave $100 credit on because they returned some of that merchandise, so they owe us $1,100. Now they're paying us back within the discount period, so they're getting a 2% discount on $1,100. So they're wiping out the receivable. 2% of $1,100 is $22. That's a sales discount, and the difference is how much cash we receive from the customer for paying their bill within the discount period. And finally, one last entry for sales, billed sales of $7,000. And those sales are now recorded just like this. And what is the cost of those sales? $4,800, debit the expense, and credit inventory. Wiping out the inventory because we've now sold it for a retail price of $7,000 and a sales and a cost of $4,800. This problem is a perfect example of retail accounting. and the various tractions, the purchase of the product for inventory, the sale of the product for inventory, freight charges, the returning of merchandise for credit, sales discounts, purchase discounts, all types of entries, all the entries you need to know for retail accounting. And there they are right there. At the same time, in regards to retail accounting, there's also inventory accounting. Many times companies keep track of inventory like this. They purchase it, they sell it, they keep a ledger of all the changes in the inventory account. Other companies, though, like to take a certain value of the inventory at a particular time, and they use inventory valuation methods to determine that. For example, this is problem 618. Here's a company with a inventory balance of product ready to be sold that costs them $50. They have 100 units, so that's $5,000. Then on March 5th, they purchase an additional 400 units of that product for inventory, but the price went up to $55. So that's $22,000 of merchandise they're producing. Then on March 18th, they buy more inventory, but the inventory now value changes to $60. It's the same product, but it goes up in price. Woo, find a new vendor. $7,200. And then finally, again, they buy 200 more units of the inventory at $62, $12,004. So during the course of this month or accounting cycle, they have 820 units available for sale, beginning and additional purchases, and the total cost of all that inventory is $46,600. All right. Well, let's say they sold 580 units of that 820 units during the month of March. So that means they had 820 units available in their inventory. They sold 580. That means they sold or have remaining 240 units of inventory. Now, because these inventory items are all the same, but they came in at different dates and different prices, how do I place a value on that 240 units? Well, we can use a series of steps called LIFO and FIFO of a way of determining the inventory values of this 240 units. What do I mean by that? Goods purchased first are the first ones sold. So your inventory is made up of the most recent purchases. LIFO, goods purchased last are the first ones out or sold. That means your inventory is made up of the early inventory items. Seems kind of weird, huh? But if you can see, a business has the options of choosing different ways of valuing their inventory. Let me show you the example. Under LIFO or FIFO, goods purchased first are the first ones sold. So remember, we had 240 units left in inventory. So this 240 units must be made up of 200 units at $62 and 40 units at $60. 40 units at $60. In other words, based on first in, first out, we assume these are the first ones sold. And what makes up the $240 ending units is 200 at 62 and 40 at 60. All the rest of those units have been sold. So if I do that, that's what? $14,800. That's my inventory valuation using the FIFO system. What that means is if my inventory was $14,800 and I have $46,600 of available inventory, the difference between $14,800 and $46,600 must be my expense, the cost of goods sold. So their expense is $31,800. The balance on their balance sheet and inventory is $14,800. Now you might be saying, Mr. Hasse, why are you doing this? Because earlier in our Chapter 5 transaction, you recorded the inventory as we went along. Okay, there's nothing wrong with that. That's called just-in-time or point-of-sale inventory. Nothing wrong with that. But a company has the option to do that or do the accounting this way after the end of the period and calculate the inventory values using these methods. The IRS lets them do it that way. Under LIFO, last in, first out, it means all these units are being sold. And what makes up the LIFO inventory is 240 units, 100 units at $50, and 240 units at $55. So our ending, oops, what did I do wrong here? Let me double check this, check my arithmetic. Okay, I fixed my arithmetic. So in last in, first out, the goods purchased last are the first ones sold. So your inventory is made up of your earliest purchases, 100 units at $50, and then 140 units at $55. 100 and 140 equals your ending inventory. So if I do that, that means our LIFO was $12,700, meaning our expense was was making sure this has to equal 46.6. So let's do that here. I still didn't fix my arithmetic, Mr. Hasse. Meaning our cost of goods sold are $33,900. They have to total the amount available for sale, the total of all the inventory. Part of this is an asset, part of this is an expense. But notice, two different methods. We're making more money here because our cost of goods sold is cheaper. We're making less money here because our cost of goods sold is more expensive. Two different methods to compute inventory. FIFO, first in, first out. LIFO, last in, first out. This is what Chapter 6 is about, is a different way of accounting for inventory. Okay, two great review problems for Chapters 5 and 6. If you go to your week 5 PowerPoint, you'll see these review problems right here. Here's the spreadsheet that I was just working on as your template, and these are good examples. In your assignment number 4, which won't be posted for another week, remember next week, week 6, there's no work. That'll be a good time to work on your project paper. But when we do have assignment 4, which is going to be posted on July 17th, which is due on the 23rd. So you have some time on that. There'll be two problems on that assignment number 4, one from Chapter 5 and one from Chapter 6, exactly like these review problems here. So there'll be your study guide for that. So this is where that information is. So again, this week, number 5, this weekend, you're posting your assignment number 3 work on the worksheet provided. You're beginning to review and get to know your project paper with your teams that you have, companies that you have selected. And maybe next week after you post your assignment 3, that'll be a good time to work on that before the assignment 4 and the final examination in the final 2 weeks of our class. So that's where we stand heading into our week 6 next week. I'm around all weekend if you have any questions or concerns. Have a great weekend, everybody, and we'll see you on Monday for week 6. Thank you. Adios.